David Roche, strategist at Quantum Strategy, joins us now. David, very good morning to you. I mean, we're in a stage where we're analyzing what's happening quick and fast, almost real time. So in that context, do you think it's enough of a reprieve for the United States to now say that they will ensure this war ends quickly and they will grant safe passage, if required, to oil tankers in the Strait of Hormuz? That's what the market is reacting to right now.
Well, of course, Trump is talking rubbish, but then he normally does talk rubbish. He hasn't won this war, he's lost it. Where's the regime change? Look at the attacks on the Gulf states and so on. So, I mean, he just wants to get home because he realizes he's losing votes on this war. Nobody wanted it. Nobody believed it was justified. He wants to get home and try and get his reputation back and establish some political credibility. But unfortunately, as usual, he's going to leave a mess behind him. But now, does that mess matter to us in markets? Straight off, you know, we've got plenty of inventory of oil and strategic reserves to cover the whole of the loss of the Gulf output if it was to last for 200 days. So within those 200 days, you've got oil. Of course, prices will react to the fact that you're using stocks rather than flows. But so there is genuine relief. Why? Because the oil price is up over $100 were never justified in the first place. The second thing is they have the power and the ability to ensure some opening of the Straits of Hormuz. There will still be attacks from Iran, which is not defeated, but they have enough firepower to ensure that there will be oil flowing, probably not at the level of previously, but a lot better than people thought of the weekend. So in that sense, I think we're looking at an improvement in the supply and demand situation. But don't fool yourself that you're going back to where you started, because you started risk. You are going to have ongoing hostilities from Iran, which I stress is not defeated. And you're looking at knock-on effects in the economies of much higher inflation, working from oil through metals to agriculture to Indian gas, containers of gas in India. So you're going to see much higher inflation, which means the central banks are not going to be feeding investors with lower and lower interest rates, the kind of adrenaline rush which the markets have had for several years. If the central banks are in any way sane, they won't be cutting rates anymore. So the biggest effect on your portfolio is the reversal of lower interest rate monetary policy.
Interesting. David, over what period do you see this playing out? So the question is, at least here in India, we were assuming that we're nearing the end of the easing cycle in any case, and we were anticipating that the monetary policy would stay steady for a while. We have seen record low inflation, both wholesale price as well as retail, and we've just seen a change in the basket of the consumer price index, which tends to favor a little more weightage for crude. So do you anticipate that sooner rather than later we'll see a shift in global monetary policy?
I think you'll see the shift in global monetary policy immediately. For example, even with the oil prices in the mid-80s, let's say, compared to where they were before the war started, you are still going to see big increases in retail prices of gasoline in the United States. So that is an economy where if it's not easing anymore, then you can say that the whole of the emerging markets will have a tough time cutting monetary policy because, you know, there's a currency risk. My guess is that for countries like India, they will go on hold. The central banks will go on hold. They're not going to panic because of this. But as the effects of a higher base level of risk and costs and prices works through all the supply chains, the distribution chains, the metal producers, the agricultural producers, fertilizer, gas for for households to cook, when that starts to work through, then you will see that the monetary policy, at the very best, won't be helping financial markets anymore. And at the worst, and certainly in America, monetary policy should be tightening, which, of course, Trump is going to not be very happy about.
Which is true. David, just wondering if this might be a good time to fish into troubled waters, especially for the economies and the markets which got hit because of the oil price disruption, right? A far bunch of East Asian economies, Korea, Japan, what have you, India, they've all gotten hit because of this. Is this too soon to call it an end and therefore start fishing? Or would you believe the levels themselves warrant some bit of buying, if not all?
Look, I think at the moment, if you can get into the markets quickly, then you should get into the markets, because anything to do with risk is going to rise. And that includes equities, it includes actually bonds, etc. But that does not solve the problems which are coming down the line, which is that growth is going to be lower and inflation is going to be higher. So what you're investing in is essentially a rally from levels which were hugely over pessimistic about what the effect of the Gulf was going to be on oil prices. So you can get into that, but don't forget that down the road, the Gulf changes the economic equation, because you are going to see higher costs, higher prices, less monetary easing. And that's going to be a problem for everybody, for profits and for central banks. So fish if you like, but remember that once you get the fish in the shore, rush home, cook it and eat it and enjoy it, and don't go back for any more.